people saying this on social media, on YouTube or whatever, is not even like if, but when it's going to crash. I saw Robert Kiyosaki, don't buy any asset for the next 18 months. This is the Cash Flow Digest. My name is Matt Faircloth, and me and the DeRosa team are here for you guys on a weekly basis, video and broadcast recording. This is also live on our Facebook group, DeRosa Insiders. In whatever medium you're watching, please take a minute and like this content. We're going to be talking about all things real estate and all things cash flow because our company is dedicated to transforming lives through real estate, and cash flow can do that. We're going to be talking about things that are affecting the real estate industry, news in the real estate investing world. And we're also going to be bringing on guests that are crushing it in the cash flow sector of real estate investing. If you guys want to join and watch the show live, please go to Facebook and look up DeRosa Insiders and join that Facebook group where we record this show every Friday at noon Eastern. Hope to see you guys there. What's going on, everybody? It's Matt Faircloth. Welcome to the Cash Flow Digest. This is an awesome program. We talk about all things real estate investing. And I'm really grateful that you guys are here listening, watching, whatever you're doing, in whatever medium that you're on, because we are on Spotify, we are on YouTube, we are on the DeRosa Insiders Facebook page. What? We're on Facebook. That's right. Y'all need to go to DeRosa Insiders on Facebook. Join our free, capital F, free community where this program goes on live at 12 noon Eastern time every week. This program is a live program for those that want to join us live, that ask live questions of myself and our guests to come and chat with us. So go to Facebook, join DeRosa Insiders, you guys to join us live. We're going to be talking about things going on in the multifamily market, AKA, is it going to crash? Who knows? Is it going to crash? When's it going to happen? We're going to talk about that. And I hear a lot of people saying this on social media, on YouTube or whatever, is not even like if, but when it's going to crash. I saw Robert Kiyosaki, don't buy any asset for the next 18 months. It's funny, there's YouTube videos predicting the crash that was going to happen 2 to 3 months ago. I saw a video that says residential is going to crash at the beginning of 2023. Oh, okay, they need to take that video down. But at the end of the day, guys, there are so many predictions on what's going to happen to overall residential housing. And today I want to talk to you guys about what people are saying is going to happen in multifamily. And what better way to have this conversation than to bring on someone here with me and maybe has a different opinion, maybe has the same opinion that I do about it. And this is an active real estate investor and also an awesome DeRosa team member, the Vincent Celeste. Come on in, Vinny.
What's up, Matt? Thanks for having me.
How are you?
Happy Friday.
Happy Friday to you. If you guys are watchers of the DeRosa Cash Flow Digest program, you know Vinny has been a host of the program in the past. Vinny is also in charge of all of our equity and marketing at the DeRosa Group. He's the real deal, man. You guys got to keep an eye on this guy. He's somebody to know at DeRosa and somebody to know in the investing world. So Vinny, thank you for joining me today on the program, and thank you for all that you do for the Cash Flow Digest and for the DeRosa community. Vinny, what are you hearing when you look on social? Let's talk multifamily. A lot of conversations around residential housing, but that's actually a different market.
It's mass hysteria, right? If you peel back the curtain here a little bit, Matt and I, we meet every week to talk about what we're going to talk about here, right? We want to know what's going on. We want to add value to everyone who takes the time to join us. So yeah, of course, we're searching the ether, and it seems like there is a lot of people crying wolf, maybe or maybe not, right? A quick search of real estate, you're going to see the thumbnail of Steve Carell in The Big Short, that movie. It's like over and over again about how everything's going to go bottoms up pretty soon. And it's just doom and gloom. And that's a sentiment for, I think, a lot of the casual watchers of real estate and people who read this stuff.
I'm not here to tell you yes, it is or no, it's not. I'm here to just discuss the logic about it. Because guess what? Logic will apply to these kinds of things a bit. Then there's also emotional frenzy that tends to happen when markets tend to really fall apart, right? But first question, Vinny, what is a crash? What do you think a market crashing is? What does that mean?
I think that's a perfect place to start. Yeah, I don't think that prices dropping means that there's a crash right away. Right. I think when prices drop and a significant portion of operators are belly up, meaning that they can't sell their property, it's not cash flowing, they can't sell it, and it's not cash flowing and they can't refinance and get out of that debt that they're in, again, at a significant portion of the market, that to me signifies a crash. I think that there's a high probability that prices start to come down, but that might not be a bad thing, even if you are an owner of real estate right now. If you've budgeted for the long term and you're enjoying cash flow, of a stable asset.
Mm-hmm.
If your price comes down, not who cares, but you can definitely weather that storm.
But here's the way I define a crash. A crash is a fundamental shift in the parameters that govern a market, right? And so what kept residential housing up all the way up through 2008 were certain lending parameters that banks were allowed to go by. No money down, low money down, no credit, no nothing, no problem, come to closing with nothing but a heartbeat and a pen. Those kinds of things are what governed a lot of the residential housing market. That overnight went away, and banks weren't allowed to do that. And a lot of the fundamentals, what propped up that market, immediately changed, right? And so that constituted a crash. The 2008 crash happened because the banks that were propping a lot of that up or creating a lot of that frenzy in the market all of a sudden went under. Number one, consumer confidence changes because it's like, well, okay, I guess I can't borrow the same dollar that I used to yesterday. And the property I'm looking at was bought under yesterday's lending terms, which don't apply today. So I can't apply that same logic to yesterday's pricing, right? All the fundamentals change. That, my friend, creates a crash. If you look at the crashes of the stock market crash, the Great Depression, if you look at the crashes that happened around 2008 or the tech bubble boom or whatever, all these things are because perceptions about the asset, whatever it is, came to be true, that these perceptions are now wrong. And there need to be new rules that govern the way that we look at either a piece of residential real estate, a tech stock, a piece of stock in the market, or a multifamily asset, right? So bottom line is there is nothing that I see that's going to completely change the fundamentals of multifamily housing, right? If the rules change to where like you could not enforce a lease, period. And a tenant could stay in a property for whatever, and a lease becomes an unenforceable document that doesn't really matter. That changes multifamily housing all across the board because that means the tenant doesn't really have to pay it. Now that's changed a little bit. It has shifted, but if leases become an invalid, that's an example of what would cause a crash in multifamily housing. Well, that's what's holding the market up in multifamily, is that tenants have to pay the rent at some point because of a lease. So those are things that would change. If banks would say, hey guys, we're no longer going to loan at all on multifamily housing, or multifamily housing now needs to be a debt service coverage ratio, which has to do with how much money you can borrow based on how much of your debt service you can pay. We used to be at 1.2. Then now the market's going to be 2.0. So it's completely changes the DSCR. That's a major shift in the rules. I'll give you one more example. The government comes in and says passive investors can no longer invest in multifamily housing, right? Yeah, you can't own multifamily housing unless you're an individual by yourself, or unless you're a corporation that's worth more than $1 billion. Those are real things that change the fundamentals of multifamily housing. None of these things are going to happen, Vinny, but those are real things that could happen that would really affect multifamily housing. But we're not looking at any of that stuff.
Yeah, and I have to highlight what you're saying too, because there are factors of our underwriting that have changed almost overnight. Like I brought this up last week, and I just bring it up every chance I have, but LTVs falling way low, right? It causing you to have to raise much more capital to get a deal done, or your loan proceeds at a refinance, not, covering your original debt. Those are risks in the market, but it's not a fundamental change in the way that we look at real estate. We still know how to value real estate. With some of the factors that you brought up, as examples, a lender or someone whose job is to appraise real estate wouldn't know how to even assess it anymore if we can't enforce a lease.
Well, that fundamentally changes. Banks fundamentally change their lending terms, like the way that you receive income, the way that you borrow money, or the way that you invest in the asset. And there's also more things that could come up, but none of those things fundamentally change. At the end of the day, the asset doesn't crash, but what it does do, and I want to introduce the concept here to everyone, is the difference, Vinny, between a crash and an adjustment. Okay. An adjustment is a real thing that has happened many, many times in real estate. It happens in stocks all the time. The Dow Jones Industrial Average may drop 10%, and they sure as heck aren't going to call that a crash, but they'll call it an adjustment. It took a breath. It took an adjustment. What an adjustment is the market realizing, hey man, maybe we got a little overheated there. Maybe we've crossed the line into unreasonable land on what things are really worth, and maybe we should catch our breath for a little bit and come back down. That's an adjustment. Somebody just typed in a correction, right? And that is really what we're talking about, is pending for multifamily. And I believe a correction or an adjustment is pending. It is likely, and it is already happening. I'm already seeing it. Let's talk about that. You've been a residential realtor for a while. What are you seeing in the world of multifamily or whatever, from what you and I have talked about, that maybe indicate towards an adjustment or a correction that could be in the realm of like 10, 15%, maybe 20, but not really even 20, probably 10% of what prices were a year or two ago is what we're probably more likely looking at.
And it's important to know that there is a correlation, of course, between residential housing and multifamily real estate, especially when we're talking about rental demand, right? And people's ability to afford homes. This is something that's come up, recently as well. It might be the most unaffordable time to buy a house in the past 40 years. It helps the multifamily industry. If you're a good operator who's able to improve the lives of your residents there, you can provide an opportunity where they're able to kind of regain, right, and hopefully become home buyers in the future. But we have to point out that it is really difficult to buy a house right now, and that does play into the multifamily market and our abilities to maintain occupancy. But you would ask, what we're seeing and what I'm seeing, and I think, one thing that's important to point out is regionality of all this stuff, right? Especially when we're just talking about like residential and multifamily. I could tell you residential real estate in where my parents are looking for houses in New York, there's still bidding wars. I could tell you as a residential broker down here in North Carolina, it's not the case. We're seeing bid-ask spreads below, what folks are asking for. And it's important to dive into your local market and where you want to invest when you're assessing risk and all this.
So and I want to underscore one thing that you just said too, in that real estate is in some ways a national thing. So because, when the 2008 market crashed, it crashed everywhere. But that's because a thing that is a national standard, debt, lending terms are not state by state. That changed. But if that all stays the same, then markets are going to be specific to that market. So the market of Atlanta may see more compression than the market of Greenville, South Carolina. Markets that saw a lot of push, like Phoenix, over the last couple of years with regards to investor affinity and people running in to get involved into the deal, probably push that market up a lot higher than it probably was supposed to logically for deals to make fiscal sense. And if the market's rising 10 to 15% per year, then it makes sense. Then that owner gets covered. And as long as they sell their hot potato very quickly, right, then they'll likely look really smart, and they really just got lucky. But what you're going to see is those markets not rise 10 to 15% in the next year or two. And you're going to see owners that expected appreciation and bought a deal that's actually on paper losing money every year. Those owners may be stuck and may have to hold for a little bit longer.
Some people are going to be forced to hold their breath, but there are operators who planned on holding their breath, right? Yeah. And bought deals that were cash flowing and that they could hold, right? So I think that the question becomes how many people, underwrote their deals like the DeRosa Group, for a 10-year hold period, where they can, facilitate this type of correction, right, or softening. And if you're able to maintain throughout that while adding value to the asset, that's really important. There will be market shifts in the values of real estate, but if you're continually adding value while you're maintaining ownership of this asset with limited risk to your cash basis, you can really capitalize when things start to turn around. But some people won't be around to enjoy it.
Not to high five DeRosa. This is not necessarily a DeRosa Group commercial per se, but I am proud to say that it is DeRosa's standard to underwrite deals under a 10-year hold. Now, if we can meet investor returns or exceed investor IRR expectations by selling sooner than that, or by refinancing at a different time frame or whatever, our obligation, as it should be for all operators, is to investors. And so if I can meet investors' expectations, and I think that we've kind of tapped out the market to where it's going to go, then we may sell. We sold a deal in Fayetteville because I feel like Fayetteville had gone where it was going to go, right? So we sold, and we did very well. We're selling a deal right now because I feel like that deal is about where I think DeRosa can take it. And so we're going to sell, make investors their IRR, and move on forward shorter than the 10-year time cycle. But by no means is it our desire to go in and hot potato a deal and bank on appreciation only to make investors their returns. Bringing it home here, guys, the way that you're going to be successful in the future, I think, as again, this is Matt Faircloth's, just opinion, for crystal ball here, is to buy deals that cash flow sooner than later, right? Invest for the long term. Right. And don't plan to hold for a year or two and sell for double what you paid for it. Plan to cash flow the deal longer term and sell longer term as the market continues to go up and maybe stays stagnant or maybe sees a 10, 15% price reduction, a correction. But that shouldn't hurt you if you bought conservatively. Right. But if you invest for the long term in real estate, you should be just fine longer term. And also just other consolation prizes, guys. That 10% price correction that we're starting to see, is likely going to be what will make the difference in a deal that you're looking at being cash positive or not. And so get ready. Again, not a crash. You're not going to see a 50% bargain discount. Like if you're walking to, you ever go shopping at Kohl's, Vinny?
Yes.
Kohl's, everything's like, it's $100, this t-shirt, but it's on sale today for $20. I hate to walk into a Kohl's when they weren't having a sale, because Kohl's is apparently having a sale. The real estate market is not going to be Kohl's. Okay. It's not going to be, everything's half off. It's going to be maybe 10% off, right? Maybe, or maybe just sticker price. And you got to find a way to make sticker price work. So that's what I'll leave you guys with. Vinny, final thoughts.
No, I love that. Yeah, it's like Men's Warehouse. You buy one suit, you get two free, and stock interest in the company and everything.
No,
so, no, I love what you said, and yeah, I agree with the sentiment there that it's important to be conservative operators and able to weather these kinds of storms and capitalize when the time turns around. So
yeah.
Thanks for having me on.
Yeah, and I get it, and that those are good analogies. So listen, guys, invest for the long term. Wait for the good deals, and great deals are made, not found. So if you can find yourself a good deal and come up with a business plan to make it a great deal, that's how you're going to win. If you're sitting on your hands and waiting for this whole house of cards to absolutely fall apart and for good deals to be growing on trees all around you, you'll be holding your breath. I've been talking to people for my 18 years of real estate investing who've been waiting for that day, and that day has never shown up. And I can promise you, I was investing in 2008 and 9 and 10. You should not pray for 2008 to happen again. Okay. I was there. You don't want that to happen because all the banks shut down. You couldn't get a loan anymore. And everybody was scared to death about putting their money into anything. I can promise you that all the confidence in the whole wide world fell apart in 2008, 9, and 10. And so you should not hope that happens again. You should hope that we look at a 10 to 15% correction, and that'll allow you to find as many good deals as you want, as long as you keep working hard and keep putting together great business plans. But I promise you, work will need to be a continued factor here. It's never going to get easy. Okay. That's what I got. Vinny, thank you for joining me. They always Starsky to my hutch, my co-host, as always, of the Cash Flow Digest. I sure appreciate you joining me today.
Thanks for having me. Talk to you guys later.
Again, if you're watching the recording of this, head out to Facebook and join DeRosa Insiders. You too can watch live and drop in awesome comments here during the program. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.